Hi, welcome back to another Question of the Week episode from Whitaker-Myers Wealth Managers. I'm John Mark Young, and this week's question is coming to us in a very, very timely fashion, just delivered this last Friday, August 2nd, 2024, as the market is in the midst of a wild two-day period, and it comes from Savannah in New Smyrna Beach, Florida. Savannah, my grandma used to always say that if you are going to winter in Florida, you better get to New Smyrna Beach or south, or you are not wintering right. So you, my friend, are in the sweet spot, according to my grandma. And Savannah asked, John Mark, what should I be thinking about in regards to the market sell-off the last 2 days? Is there anything I need to do or any way I need to position my retirement portfolio? Well, Savannah, timely question, as I mentioned above, and one that I do believe many people are going to be wondering if they pull up their investment statement online, should I be doing something? Because the balance is significantly changed from what it was a few days ago. Here's what happened, Savannah. Stocks fell on Thursday and Friday, about 3% for the S&P 500, which is our growth and income categories, about 4% for the international markets, which didn't have a lot of return already for the year, so they're one of the worst for the year, still positive, but very low now. And about 7% for the Russell 2000, or aggressive growth in our Dave Ramsey vernacular. That category was just making its comeback. This is happening because the U.S. economy is weakening much faster than we previously thought, and a highly accurate tool called the SAM rule is being triggered. Now, what is the SAM rule? The SAM rule says, it's named after this economist, Claudia Sam, and she has accurately forecasted almost every recession in the U.S. since 1970. And it says if the jobless rate, which was just released today, Friday, August 2nd, for the month of July, and I should clarify, we're talking about the 3-month average of the jobless rate, not just this month's. But if the 3-month average of the jobless rate goes to 0.5% above its lowest point in the previous 12 months, we have tipped into a recession. So the economy is slowing, and now the question is, have we missed our soft landing? Are we going to a medium landing, or now maybe even a hard landing? Is the economy getting ready for some rough parts? Are we going into recession? We are less than convinced that this is actually the case. First, because as Sumit Puri, who does an excellent job on our What We Learned in the Markets This Week video, will tell you, the Atlanta Fed's GDP Now model, which tracks the growth of the economy in real time with real data, is currently at 2.5%, and the average Wall Street economist is currently predicting 2% growth for the U.S. economy in the third quarter of 2024. So from that perspective, nobody's expecting recession. The current data says no recession. And remember, recession is generally 2 straight negative quarters of growth, two quarters of negative growth, I should say. And we've already had one of those in President Biden's term, although the Bureau of Economic Analysis did not count it. Okay, so all that to say, we've broken the SAM rule, okay? 0.5% inflation over our lowest point. Next, we know that Federal Reserve Chair Powell, who had one of their scheduled meetings this last week, wants the market and the economy to cool off to kill inflation. He wants the economy to slow down. And based on statements from earlier this year, when the jobs number that we get from BLS is right before a Fed meeting, we know that the BLS gives him a heads up on that data. He told us that. So this tells us that he was very precise with his statements this last week, saying he still wants more data to determine that the economy is slowing and inflation is dying before we try to stimulate the economy with lower rates. Now, why would he say this when he knew what that BLS data was? This unemployment data that came out so bad today. He knew that he was going to get a bad job number this Friday. And my opinion is cutting rates right before the presidential election in September, which is now the odds-on favorite when we'll get our first rate cut because there is no meeting in the month of August. This allows him to push back against any narrative that his rate cuts were politically motivated. If he cut rates right now in August, it might seem like he is trying to help the Harris ticket, whereas cutting in September, after this very bad jobs report today, and potentially more inflation data in August and early September that proves inflation is slowing, he looks more like a market-driven move than a political-driven move. If the labor market is falling fast and inflation is also falling fast, that's almost the perfect backdrop for the Fed to step in and say, hey, notwithstanding any elections, we have to start cutting rates. Now it's not about the election, or nobody can say it is. I'm not saying it is, but I'm definitely saying there are people that would say it is. And so this allows Fed Chair Powell to say, it's not about the election if I don't do it in August. after this jobs number came out today. But when the job numbers comes out really bad and we don't have a rate cut, you see the market doing what it's doing. Now, all that to say, we would call this a normal market scare. And that's going to happen when you invest. As you can see on your screen, a 5% drop is going to happen almost every single year, according to the chart from Charlie Bellello. And a 10% drop? How often does that happen? Well, that's almost every year as well. Oh, goodness. How about 15% drops? For every 5-year period, you'll probably see 2 15% drops. 20% is going to happen once every 4 years, and 30%, 30%. We haven't had one of those since COVID. That's going to happen almost every decade. In 2022, the S&P 500 saw a 25% decline at its worst. So we did not hit that 30% decline in 2022. So why should you not freak out right now, Savannah, or any other listener that is watching this video? Well, that is the most logical question in the world right now when you see what's happened in the market the last few days. Well, there's 2 reasons why you shouldn't freak out. First, as we discussed, this is a normal part of investing. Second, the good news, and I'll be honest, I'm ecstatic about this, is how well bonds are doing, how well your hedged investment. For those that are in retirement or very close to retirement, you have inevitably hedged yourself with real estate, with bonds, and perhaps some other types of investment. Real estate's doing okay, not great, but they're having a positive 0.36 or positive 2.4% on the year for the 2 funds that we monitor. Better than international stocks at this point, other than India. That is poised for a good year soon, my friends, we believe, because interest rates are in a free fall, and that will open up the refinance markets and residential real estate markets, providing an opportunity for balance sheet improvement for many Americans, as Summit Puri has been talking about on what we learned in the markets this week. And that will help the real estate markets in large continue their ascension to a higher level. But bonds are having a great year for being a safer asset that they are. A few bonds we monitor are the PIMCO Income Fund, which is up 4.84% this year, and the Performance Trust Strategic Income Fund, which is up 4.95% this year. And many of our clients have bought individual U.S. Treasury bonds, which are more than likely returning about 3% range at this point in the year, with extremely low risk. So, Savannah, we tell you not to freak out, even if this leads to a recession, which we don't think, but it's possible. If you're closer to retirement and you've properly hedged your portfolio, that is more than likely doing extremely well. Unlike 2022, when those assets had their worst year since 1842. Additionally, we like to remind you that while the news cycle changes, meaning the event that drives the market lower is constantly changing. It's a different story, same outcome, different story. The story always ends the same, and that is consistency is key. In most years, August is the most volatile month. Last year, August kicked off a nearly 20% decline through August, September, and October until the markets kicked it into overdrive in November. And so this year seems to be right in line with that. August is providing an opportunity for the markets to get a little nasty, but the long-term trend is your friend. The trend is your friend, my friend. And that is to say that these drops are normal. You have to live through them. You have to avoid selling stocks to them. And the beautiful thing is in a week and a half, your 401k is going to make a deposit that is going to take advantage of these drops. So if you have more individual questions, please contact your financial advisor. But this would be something we would tell you. All you do is look for an opportunity to rebalance, which we're constantly looking for our clients. You look for an opportunity to continue to save and invest. So you're buying on the dip, so to speak, and you don't make any emotional or fear-based decisions. Thanks so much for watching this week's video. If this week's video was helpful to you, you can do us a favor by hitting the like and the subscribe button. That helps us with YouTube, Google, and Rumble's algorithms. And you can go to the comment section of this video where you can click a link to schedule a meeting with any of our financial coaches who help you in baby steps 1, 2, and 3, and our financial planners who help you in baby steps 4, 5, and 6. Thanks so much for watching this week's video. We'll look forward to seeing you next week.